Hey everyone, Larry Bailey here, and I'm bringing you this week's mortgage information weekly newsletter. This information is coming to you from MBS Highway, your trusted source for mortgage market intelligence. It's also coming to you and supported by Awesome Technologies Inc. Everybody, whoever's listening to this, I know you have payroll. I know you're paying people. Make sure you're doing it in a most constructive way, most efficient way, most helpful way. Can even be kind of fun. I know it's kind of weird, but with ATI's eCompensate platform, it actually helps make sure everybody knows what they're getting paid, when they're getting paid, if there's any draws, any holdbacks, any bonuses, any really anything that you want to make sure goes through payroll. It's all automated and it's got an easy user interface going back and forth, so you don't have to do these emails, you don't have to do these text messages, you don't have to have these surprises at the last second, because nobody likes surprises with payroll. So head over to awesometechinc.com and look at eCompensate under the solutions, and you can just email over if you want more information, info@awesometechinc.com. Let's get into this newsletter. Today's June 3rd, 2024, and this information is going to review the week of May 27th, 2024. So here we go. The progress towards the Fed's 2% inflation target remains stalled, while signed contracts on existing homes fell in April. Meanwhile, home prices continue to hit new highs this year. Read on for these stories and more, and listen in on. I'm going to read. You're going to listen. It's Monday. Welcome back. Hopefully, everybody had a great weekend. So here's the first story. Inflation not heating up, but not cooling off. Next story is pending homes sales plunge in April. Next story is home price gains continue. The next story is first quarter GDP weaker than initially reported. And the last story of the day is initial jobless claims tick slightly higher. So if you're listening to this on podcast, thank you very much. You can always catch the video and everything we're sharing on screen over at mortgage.community. It's free to join. It's open to everybody. And you can also, if you go there, you can also check out all the other information that's available, especially if you're using Encompass by ICE Mortgage Technology. So here's our first story. Inflation is not heating up, but also not cooling off. And if you listened to me last week, I talked to you about the Fed's favored measure of figuring out what's going on with the economy, the personal consumption expenditures. And I said, I was listening to a news story, and they actually started teaching people, or trying to teach people, about PCE. I just thought it was funny. But it came out on Friday. And so April's personal consumption expenditures, PCE, showed that the headline inflation rose 0.3% from March, with the year-over-year reading holding steady at 2.7%. The core PCE, the Fed's preferred method, which strips out all those volatile food and energy prices, that also rose by 0.2% monthly. The year-over-year reading for that remained at 2.8%. So this feels like it's stalling towards the Fed's 2% target. So what's the bottom line? The Fed has been working hard to tame inflation, hiking its benchmark Fed funds rate. We know this since March of 22 through July of 23. Remember, that's the overnight rate that banks get to borrow from the Fed. That's how much the Fed charges them. So these hikes were designed to slow the economy by making borrowing more expensive and lowering demand for goods. So that would hopefully release the pressure on pricing and inflation. Everything would shrink. The Fed's held rates steady since last September because inflation had been making good progress lower late last year before stalling more recently. Fed members have emphasized that they do not expect to cut rates until they're confident that inflation is moving sustainably towards their 2% target. Matter of fact, in last week's review, we talked about they wanted to see, some of these Fed members wanted to see several months of good information that their monetary policy is working in the way that they want it to work. So what's happening now is we saw a sharp rise in the unemployment rate, which had been in the narrow range between 3.7 and 3.9% since last August. This could also impact the Fed's timing for rate cuts given their dual mandate. Remember, they have two jobs. Number one, stabilize prices. Number two, maximum employment. And so the unemployment rate for May will be reported this Friday. So we'll see what happens. Here we got some news. Next story is pending home sales plunge in April. And what we're seeing on screen is brought to you from the National Association of Realtors. And you can see on screen here if you're watching this, but the 2021 average was had an index of 115.2. We just saw an index of 72.3 in April's reading. So what does that mean? So the pending home sales fell 7.7% from March to April per the National Association of Realtors, that's also known as the NAR, coming in well below estimates of a modest decline. Sales were also 7.4% lower than they were a year earlier. This report measures signed contracts on existing homes, making it an important forward-looking indicator for closings on these homes as measured in the existing home sales report. Bottom line here is the pending home sales index took a big turn lower in April after a strong reading in March, with the NAR's chief economist Lawrence Yun explaining that, quote, the impact of escalating interest rates throughout April dampened home buying, even with more inventory in the market, close quote. I don't know. I see a different trend line here. And I think mortgage rates had some impact. But it's really weird, and this is again my own personal commentary, but it's really weird. You've got more supply and you have fewer contracts signed. I think if I know the average buyer out there, they don't have to move, so they don't want to move, or they don't have to buy, so they don't want to buy, and they're waiting. I bet they're waiting for lower prices. I think it's a mistake, but we shall see. So next story is home price gains continue, and this is why, again, I think it's a mistake to wait. We've said it on this review where, don't wait to buy. I've said it 1,000 times. Money should not be the determining factor. Now, if you can't qualify or you can't afford the mortgage payment, obviously you shouldn't buy the home. But waiting for a good deal never pans out. I shouldn't say never. Almost never pans out in real estate. Usually you end up missing way more often than you end up hitting it in the right spot. So home price gains continue, and we see a graphic on here for the Case-Shiller Home Price Index. So the Case-Shiller Home Price Index, which is considered the quote gold standard for appreciation, showed home prices nationwide rose 0.3% from February to March after seasonal adjustment. Home values in March were also 6.5% higher than a year earlier, unchanged from the previous report. And there's a map on here. There's an image, and the only one that's falling looks like is Washington D.C. I can't really see the image on there, but it looks like Washington D.C. Everything else is either light blue or dark blue, representing percentage change. So the Federal Housing Finance Agency's House Price Index, that's known as the FHFA, also reported a 0.1% jump in home prices from February to March, with prices 6.7% higher than previous year. It's important to note that the FHFA does not include cash buyers and also doesn't include any loans that are in excess of conforming loan limits. So these factors account for some of the differences in these two reports between the FHFA and the Case-Shiller. Bottom line here, gang, March's report, quote, boasts another all-time high, close quote, for home prices, confirmed by S&P's DJI head of commodities, Brian D. Luke. Brian said, quote, on a seasonal adjusted basis, national home prices have reached their 9th all-time high within the past year, with all 12 metropolitan markets posting positive annual gains for the 4th consecutive month, indicating a widespread and sustained growth in the housing sector, close quote. These indexes show that homeownership remains a fantastic opportunity for families to create wealth through appreciation gains. Absolutely. Absolutely. It's very, very true. Here's the next story. The first quarter GDP is weaker than initially reported. And this is, by the way, anytime you have these reports come out, remember there's 3 reports in the GDP. There's the initial, there's the revised, and there's the final. So here's what we're talking about. The U.S. economy grew more slowly than previously thought during the first quarter, per the Bureau of Economic Analysis, as their second estimate of GDP for that period showed 1.3% growth. This was down from 1.6% pace that was initially reported and well below the 3.4% growth seen in the fourth quarter of last year. It's important to note that this data is subject to one more revision, which is the final reading, which is released on June 27th, so about 3.5 weeks from now. So bottom line here with this story is GDP functions as a scorecard for the country's economic health, so signs of a slowdown are a concern. They also coincide with the Fed's latest Beige Book survey of regional Fed bank districts, which showed that, quote, overall outlook grew somewhat more pessimistic amid reports of rising uncertainty and greater downside risks, close quote. So let's get into this next story. This one's about initial jobless claims ticking slightly higher. So the initial jobless claims rose by 3,000 in the latest week, with 219,000 people filing for new unemployment claims. There's also 1.791 million people still receiving benefits after filing their initial claim, as continuing claims increased by 4,000. So bottom line with this story is with the job openings and labor turnover summary report, that's the JOLTS report, it showed that the pace of hiring has slowed over the past year. It will also be important to see if an uptick in unemployment claims continues because, as noted above, the Fed members are closely watching for signs that labor sector is softening as they weigh their timing for rate cuts this year. Here's a family hack of the week. June is National Mango Month. Who knew? So there's a really nice recipe on here. If you're listening on replay, if you want to check out the family hack of the week for this mango recipe, if that's your thing, head over to mortgage.community and look at around the 11-minute mark for the recipe here on the screen. Here's what we're going to see for this week, gang. We're going to see more appreciation data from CoreLogic on Tuesday. Then the labor sector news will dominate the headlines the rest of the week. Look for updates on job openings Tuesday, private payrolls Wednesday, unemployment claims Thursday, non-farm payrolls and unemployment rate Friday. Right now, we're seeing that. I don't know if you were watching this from the beginning, but we were up 11 basis points with the mortgage back. We're now up 27 basis points. Remember, we want to see U.S. Treasury go down. We want that cost of money to go down from the Treasury, and we want the price of the mortgage-backed security go higher. That's a price versus rate. So when prices go higher, rates come down. And in this particular case, the treasuries are gaining ground money-wise, and that's causing the yield to drop. So my name's Larry Bailey. Thank you very much for always listening in, and head over to mortgage.community, and we'll see you there. Thank you. Take care.